Today, thousands of Australian citizens move to the US each year and are immediately subject to the US tax system. Yet many Aussie expats either do not understand how the US tax code will affect their overall financial holdings or do not have an effective tax strategy in place to gain the most advantageous tax position. If you have recently arrived in the US or are considering relocation, you likely have a number of questions. For example, how will the Internal Revenue Service view your holdings in Australia, especially your superannuation funds? Are you aware of tax reporting deadlines and penalties for non-compliance? By viewing this video, you will better understand how relocating to the US will affect your tax liability, tax reporting requirements for worldwide assets, including income from foreign accounts, why superannuation funds must be addressed, elements of the US tax reporting system that affect Australian expats. This video highlights some of the most important US tax principles for Australian expats to understand. As you will discover, the U.S. tax system requires complex reporting with significant penalties for non-compliance. With advanced preparation, you can plan your move strategically and position yourself for financial success. As always, it is best to consult with a tax advisor who may confirm the applicability of the U.S. tax law to your U.S. tax situation.
Generally speaking, if you are considered a tax resident in the U.S., you will be subject to tax on your worldwide income, including income generated from a tax-deferred account in another country. This can present challenges for Australians moving to the U.S. who still have assets that earn income in Australia, especially when those assets don't quite match up with instruments in the U.S. Taxes can be complex anywhere, so the best place to start is with an understanding of the various levels of taxation in the U.S. The U.S. government imposes a federal income tax that is based on income levels. The federal government recently enacted tax reform, which retained 7 tax brackets but changed the rates ranging from 10% to 37%. It is important to determine how state taxation will factor into where you decide to live. Most states impose personal income tax, with the exception of Alaska, Florida, Nevada, South Dakota, Texas, Washington, and Wyoming. State income taxes vary, but are generally in the range of 0 to 12.3%. The third level of taxation is Social Security tax and Medicare FICA. This is based on earned income, such as salary paid to an employee or a sole proprietor's earnings. The U.S. Social Security tax of 6.2% is paid on wages up to a maximum of $147,000 for the 2022 tax year. The Medicare tax is an additional 1.45% on wages, in which there is no maximum. Combined, this tax is commonly referred to as FICA, Social Security, or self-employment tax. If you are an employee, the employer pays FICA tax of 6.2% and Medicare tax of 1.45% on wages. If you are a sole proprietor, you pay both the employee and employer portion, which is 12.4% for FICA and 2.9% for Medicare. The fourth level of taxation is local income tax. Local income tax, which generally refers to additional city or county tax, depends on your work location. Generally speaking, local taxes are not higher than 1 to 2%, with the exception of New York City. The U.S. income tax year is based on the calendar year. Tax returns and payments must generally be filed by April 15th of the following year. While extensions may be filed, interest and penalty may be charged on any tax paid after April 15th. As previously mentioned, the U.S. taxes its citizens and individuals who are residents for income tax purposes on their worldwide income. When income is sourced in a foreign country, the U.S. generally allows a credit for the tax paid on that same taxed income. In the U.S., married couples have the option to file jointly or separately on their federal income tax returns. By filing a joint tax return, you can benefit from several tax breaks compared to filing separately. In some cases, it could make more sense to file separate returns. All individuals filing tax returns must have a U.S. Social Security number, referred to as an SSN, or an individual tax identification number, referred to as an ITIN. ITINs are important for selling residences, obtaining driver's licenses, opening certain bank accounts, and more. Australians planning to work in the U.S. should be aware that the U.S. has different business entities. Australia generally has 6 main structures: a sole trader, a company, partnership, trust, unlimited proprietary, and proprietary limited. The U.S. business structures also include several entities, including limited liability companies, referred to as an LLC, partnerships, corporations, S corporations, and single-member LLCs. For U.S. tax purposes, a C corporation pays income tax at the corporate level separate from its owners. Conversely, the income of a pass-through entity, which includes an S corporation, LLC, partnership, and single-member LLC, flows through to its individual owners' personal income tax return. A pass-through entity generally does not pay federal income tax on its own. Keep in mind that the business structure you have in Australia may be treated differently in the U.S. A formal bilateral agreement between two countries, a tax treaty, commonly known as a double tax agreement, exists mostly for the purpose of preventing double taxation. A tax treaty fosters cooperation between countries and allows each to enforce its respective tax laws. DTAs also exist to specify rules to resolve dual claims in relation to the residential status of a taxpayer and the source of income. Australia's tax treaty with the U.S. dates back to the 1950s and has been amended through the years. It was one of the first DTAs. For Australians, tax treaties relate to their residency status and how tax applies to the income and business profits they earn, or tax relief they receive, in the U.S. Of particular interest for Australian individuals living in the U.S. is if you are considered to be an Australian resident for tax purposes under Australian domestic law and a U.S. resident for U.S. tax purposes under U.S. domestic law, the tax treaty provides rules to ensure you are only a tax resident of one of those countries. If you are earning income from both countries, the tax treaty allocates taxing rights over certain categories of income between Australia and the U.S. If you earned $140,000 of income in Australia and pay $42,000 of income tax as a non-resident Australian, you may qualify to claim a foreign tax credit of up to $42,000. In this example, you would make a claim of a foreign tax credit Form 1116 or an 1116 on your U.S. tax return. A foreign tax credit is generally offered by countries with income tax systems that tax residents on worldwide income. These tax credits mitigate double taxation. A common question for Australian expats in the U.S. is how to treat Australian dividends income for U.S. tax purposes. The franked amount should be reported as qualified dividends in the U.S. The imputation credit is not income and is not considered a credit on the U.S. tax return. The Treaty Tiebreaker is a provision meant to prevent an individual from being deemed a resident in both treaty countries. Typically, a multi-step procedure will be applied to resolve the problem of dual residence. In most cases, the location of a permanent home will be the critical determinant in resolving residency. The Treaty Tiebreaker only applies to the calculation of U.S. income tax by treating the taxpayer as a non-resident of the U.S., but only for income tax purposes. Any informational forms that would be required of a resident will still need to be filed. What happens when you leave Australia halfway through the year? Are you a resident or a non-resident for individual tax purposes? The Substantial Presence Test, SPT for short, is a criterion that the IRS uses to ensure that an individual qualifies as either a resident or non-resident for tax purposes. To meet this test, you must be physically present in the U.S. on at least 31 days during the current year and 183 days during the 3-year period that includes the current year and the 2 years immediately before that, counting all the days you were present in the current year, 1/3 of the days you were present in the first year before the current year, and 1/6 of the days you were present in the second year before the current year. Under the U.S. Tax Code, a first-year election can be used by non-resident individuals who arrive in the U.S. after the midway point of the tax year and do not obtain a green card in that year, but do qualify as a resident individual in the following year under the SPT. Therefore, an individual who makes the first-year election will be treated as a non-resident individual for part of the tax year and a resident individual for the other part of the tax year. To make the first-year election, the individual generally must satisfy 5 requirements. The first, they must have been a non-resident in the previous tax year. The second, must not meet the SPT or green card test in the current year. Third, must satisfy the 31 consecutive day requirement. Fourth, must satisfy the period of continuous presence requirement. And finally, must meet the SPT in the subsequent year. There are also additional elections for individuals who are married and want to file jointly.
Australian residents receive a full exemption from capital gains tax on the sale of a home that has served as their main residence throughout ownership. Until recently, they benefited from an absence rule, which allowed them to treat a dwelling as their main residence for capital gain tax purposes for an unlimited period of time, as long as they kept it empty and did not rent it out. Under recent reform, Australian homeowners who sell their main residence while they are working overseas will lose the CGT exemption. The new law was specifically intended to exclude foreigners from obtaining the capital gains exemption, and expats were included in this measure. This means Australian homeowners had until June 30, 2020 to sell their homes without being subject to the capital gains tax. Because the U.S. taxes worldwide income, some of the proceeds from the sale of your home may be included in that amount. As earlier stated, there is no tax in the U.S. if you reside in the Australian residence for 2 of the past 5 years. The capital gain exclusion is $250,000 for a single person and $500,000 for married persons filing jointly. If you pay the tax on the transaction in Australia, those taxes can potentially be claimed as a foreign tax credit on your U.S. return. However, if you sell your Australian home before the June 2020 deadline, you will need to include the income from the sale on your U.S. tax return as part of your worldwide income, even though there is no capital gains tax prior to June 2020 in Australia. You may or may not owe taxes on this overall sale in the U.S. Also, If you own rental property in Australia, you must report any income on that property in the U.S. You are entitled to the same deductions you would normally receive in Australia, plus you are entitled to depreciation over a 40-year period, an added benefit that the IRS allows in its tax code. You'll also want to give careful consideration to the disposal of your Australian assets and the potential tax ramifications of doing so. As a U.S. resident, for tax purposes, any sale of Australian assets would be subject to U.S. taxation. Any Australian taxes paid would be subject to the foreign tax credit calculations. You will want to be strategic about the timing of paying off a mortgage, as it could trigger ordinary income from a mortgage disposition exchange gain. Other considerations include managed fund or other trust distributions. You will want to work with your tax advisor to ensure that your Australian investment assets are managed and structured in the most advantageous way. The income generated from those assets will affect your U.S. taxes and must be reported on the appropriate forms to avoid any penalties.
As we addressed in Chapter 2, Australia has an international tax treaty with the U.S. and has signed a FATCA, Foreign Asset Tax Compliance Act agreement. The type of assets, investments, and income you maintain overseas will dictate the layers of complexity for the reporting requirements you will have in the U.S. The type of assets, investments, and income you maintain overseas will dictate the layers of complexity for the reporting requirements you will have in the U.S. The information in this chapter provides a guide to what these reports are and how they may apply to you. FBAR is a report of foreign bank and financial accounts, or more simply, a foreign bank account report. The FBAR form is filed electronically with the Financial Crimes Enforcement Unit, a division of the U.S. Department of Treasury. When a person owns or has signature authority of an account or accounts with an annual aggregate balance that exceeds $10,000 US in foreign and overseas accounts on any given day during the calendar year. It is important to note that taxpayers who must file this report in the U.S. include legal permanent residents, green card holders, individuals claiming a treaty tiebreaker, and U.S. part-year tax residents. Foreign accounts include bank, investment, and financial accounts, and insurance policies with a combined value of more than $10,000 US. Also note that superannuation funds, which we will address in Chapter 5, must be reported on an FBAR form each year. The penalty for failing to file an FBAR is $10,000 US and can be levied in cases of willful violation. FATCA is intended to prevent tax evasion by U.S. taxpayers using offshore accounts. FATCA requires certain U.S. taxpayers who hold foreign financial assets with an aggregate value of more than the reporting threshold, at least $50,000 US, to report information about those assets on Form 8938, which must be attached to the taxpayer's annual income tax return. As mentioned before, this form is used to report specified foreign financial assets if the total value of all the specified foreign assets in which you have an interest is more than the appropriate reporting threshold. Generally, if an Australian citizen who becomes a tax resident of the U.S. and owns a mutual fund in a non-U.S. account, this would be considered a PFIC. The IRS requires that anyone with an interest in a PFIC file an annual disclosure and indicate any growth in this investment and any income generated. It's important to disclose PFICs in your initial year of U.S. residency, as certain elections can only be made in the first year. Do you own an Australian mutual fund and plan to live in the U.S.? What about foreign trusts, partnership, or a PTY Ltd? Disposal of any Australian assets must be carefully planned with regard to both Australian and U.S. capital gains laws. Of course, any of these assets will be factored into the worldwide income calculations with regard to U.S. taxation and filing requirements. For example, there are a host of international reporting requirements, which include, but are not limited to, foreign gift, Form 3520, foreign corporation or foreign partnership, Form 5471 or Form 8865, Foreign trusts, Form 3520A. Passive foreign investment companies, Form 8621. Your requirement to file certain forms will depend on what percentage of ownership you have in a business. As you know, superannuation funds are required of most individuals working in Australia. In most cases, both the employer and employee deposit funds into the super, which offers preferential tax rates on future investment earnings. More specifically, the super is funded by mandatory employer contributions, which are generally tax-deductible contributions made by the employer as a percentage of the employee's salary. They can also contain concessional voluntary employee pre-tax contributions and non-concessional voluntary pre-tax contributions, which are not tax-deductible but can include contributions from take-home pay, inheritances, and proceeds from asset sales. In our earlier discussion about tax treaties, we addressed how the U.S. and Australia resolve tax conflicts in a cooperative fashion to avoid double taxation. That works well when dealing with similar financial instruments. Supers, which are generally run as trusts, do not have an exact U.S. counterpart and are more of a hybrid of several U.S. savings and retirement accounts. Currently, there is no definitive guidance from the IRS on how to treat these accounts for U.S. tax purposes. As a result, opinions vary on how the income from these accounts should be taxed on your U.S. income tax return. Typically, a super is treated as an employee benefits trust or a foreign grantor trust. The IRS looks at the contributions made into the super to determine grantor trust status. If an employee's contribution is equal or less than an employer's, then it's an employee trust considered owned by the foreign employer. If the individual personally funded more than 50% of the super, it is more likely to be a grantor trust. The super may be considered a grantor trust in the U.S. under certain conditions, such as when the relevant grantor individual directly or indirectly made a transfer to the trust within 5 years of becoming a U.S. resident. This matters from a U.S. tax perspective because the grantor will be taxed on their income and capital gains from the trust assets, regardless of whether those amounts are actually distributed. If the super is treated as a foreign grantor trust, additional reporting is required. Account ownership and annual income from the account is required to be reported on Forms 3520 and 3520A. Contributions and any growth in the account are taxed on the U.S. Form 1040. PFIC investments within the accounts also require the filing of Form 8621 each year. As with the employee benefit trusts, Form 8938 and the FinCEN 114 form may also be required if you meet the reporting requirements. Those are the general parameters in the U.S. taxation of supers, but given the complexity and lack of good guidance in the area, you should work with your tax advisor to determine the proper tax treatment. If the account is categorized as an employee benefits trust, where the foreign employer is considered to be the owner, any contributions to the account are taxable in the U.S. in the year of contribution, even if Australian tax is deferred. Income deemed to be taxable in the U.S. needs to be reported on your U.S. tax return, and the account ownership is required to be reported on Form 8938 if you meet the filing requirements. U.S. treatment of supers vary on a case-by-case basis. Here are two examples of how contributions and fund growth would be treated under the U.S. tax system. An Australian U.S. citizen is living and working in Australia. They are self-employed and operate a self-directed and self-funded super. The likely U.S. tax filings. The super would be considered a grantor trust and would face the following U.S. tax treatment. The employer contributions made on behalf of the employee are 100% taxable. Employee contributions are not considered tax deferred in the U.S. Growth attributable to the employer is fully taxable as ordinary income. Growth attributable to the employee is taxed as a grantor trust in Form 3520A. Distributions are tax-free in the U.S. to the extent of basis. PFIC reporting is required if the fund holds mutual fund type investments. An Australian individual and spouse relocate to the U.S. on a 3-year assignment, arriving on March 1, 2017. Later that year, the spouse acquires a U.S. job. Their children remain at home in Australia attending university. The couple has joint ownership over a non-U.S. bank account, and each has a superannuation fund in their name. The combined growth in value of the funds is $4,000 during the U.S. tax year, with no fund distributions. The majority of contributions were funded by each individual's employer throughout their career so far. The couple elect to file as a full-year U.S. tax resident on a joint tax return as it results in a lower overall U.S. federal and state tax liability. Their children are not eligible to be claimed as dependents as they are not considered residents in the U.S. Both spouses are not considered highly compensated individuals under U.S. tax law, meaning they earned less than $120,000 in the preceding year. Both spouses report their share of interest income earned on their non-U.S. savings account. Both spouses report their interest in non-U.S. bank accounts and the superannuation accounts on Form 8938. Both spouses report their interest in non-U.S. bank accounts and the superannuation accounts on FinCEN 114, the FBAR. The $4,000 growth in value of the superannuation fund is not reported as income during the tax year. The super funds are considered non-U.S. trusts owned by the Australian employers, so there is no additional U.S. information reporting. In other words, Form 3528. Neither individual is considered a highly compensated individual, resulting in deferred taxation of unrealized gains. In other words, subject to tax upon distribution. The last thing you want when you relocate from Australia to the U.S. is to pay extra taxes or penalties that could be avoided with pre-departure planning. The information presented provides you with an overview of the issues you should be aware of and raises questions that could merit further discussion. As we discussed, tax treaties are useful instruments for two countries to determine fair taxation of an individual. However, given complexities that don't neatly fit the tax treaty framework, it is best to learn how to proficiently navigate the process and ensure that you comply with all required filing rules. EFPR Group works closely with their clients to arrive at the best approaches for your particular set of circumstances. Ideally, we work with individuals and businesses pre-departure, and upon arrival, advanced planning is critical to attain maximum tax savings for you. If you would like to reach out to me or one of our international tax experts, our contact information is in the description below.